All right, good afternoon, everyone. You've made it to the last session of the day, so thank you very much. And thank you for attending this session. We've all heard a great deal about private equity as a primary method for investment into Africa, but our goal this afternoon is to delve a little bit deeper into that and discuss some of the issues and drivers. So with that, I would like to start the panel discussion. And I'll take a brief moment to introduce our panelists, and then we will dive right in. To my immediate left, we have Sujoy Bose of the IFC, where he's a chief investment officer and heads the African, Latin American, and Caribbean Fund, which currently stands at $1 billion. Next, we have Kamal Palan, and Kamal is chief operating officer of Kuramo Capital Management in New York, a PE firm, which also has offices in Africa. Next, we have Chijoke Dozie, and he is director and co-founder of Kaizen Venture Partners, which specializes in providing long-term capital to distressed companies and technical expertise. He's also worked at the IFC, and he has an MBA from Harvard, so please do not hold that against him today. Then we have John Opobo, and he is a director at Actis. Actis needs little introduction. At Actis, he's focused on healthcare, consumer, and financial services, and industrials. And then finally, down at the end, we have Pradeep Ramurthy. He works for Abraj Group's engagement, works with Abraj, and he is responsible for engagement with stakeholders in North America. He's also worked under 2 presidents and was the first ever senior director for global engagement from 2009 to 2011. So let's get into our discussion. I know we've heard a lot of varying remarks today, and we're going to touch on some of them. But to get started on private equity at first, we've seen so far 19 deals to date this year, totaling $13.9 billion in terms of just deal flow into Africa. And that's probably almost a 10% growth rate over last year, and that's according to merger market data. And of the top 10 Africa deals announced, 7 of the companies were acquired by a PE firm. 4 of those were by Actis alone. So, John, what's driving Actis's investment this year?
Thanks, Kimberly. From our perspective, Africa is a very important part of our strategy. Of the funds that we invest, generally speaking, around 40% of those total funds for global PE, global emerging markets PE, are invested in Africa. I think broadly speaking, we believe very strongly in the Africa story still. Other emerging markets, I think, have had a fair amount of difficulty. Africa is still very, very strong. I think we'll talk later about the capital flows that are coming into the market there. But even with that, there's still a great deal of opportunity. GDP drivers, population growth, growth in the middle class, income, infrastructure, et cetera, all those themes are still very, very large drivers for us. And I think from a very macro perspective, we have a lot of faith in Africa.
Okay, great. Kamal, in the work that you do, in terms of the fundraising work, have you seen a shift in deal dynamics? What are you seeing in the market? Is there increased competition with more funds entering the market?
Yeah, thank you, Kimberly. Great. I think in terms of some of the underlying deal dynamics, and John touched upon it, which is the capital flows, I'll start with that. I think from our perspective, I think there's a misconception in the market that there's probably too much capital in the market. You and I talked about this earlier. So when you look at some of the fundraising targets in the market, it seems like there's 50, 60 GPs in the market that are trying to raise capital, and the fundraising targets for this year are $12, $13 billion. But I think if you look at what's actually been raised, it's a number that's far short. It's maybe $2 billion or $3 billion. So a fraction of what is actually being targeted is actually being raised. So we don't think necessarily there's too much money in the market. We think that potentially there's too much money chasing a few deals, like the very, very largest deals. But in our perspective, we think that there's actually a lack of capital in maybe some of the middle and some of the smaller ends of the market.
So Joy, do you want to comment on that?
We had one of our LPs visiting last week who had this concern that a lot of money was being raised for Africa. And then I had a chat with the IFC's, the guy who heads up IFC's PE group, which several of you I'm sure know well. And his concern was exactly the opposite, something like what Kamal was saying, that a lot of GPs are visiting LPs, but a lot of, and some money is being raised, but not necessarily enough. And I think what it's going to pivot on is whether a couple of the big areas that people are expecting to open up in Africa, if those areas open up, for example, Nigeria Power, then there's a significant change in the amount of capital that's needed. So from our shoes, we are, like Kamal said, for certain deals, there's a lot of money chasing them, but we are also seeing a lot of deals where valuations are actually not that bad, and there is still a bit of risk averseness when it comes to those certain deals.
Would anyone else like to chime in on that?
So from our perspective, and I know we talked about this before, the merger markets data doesn't include a deal that we just concluded, which is the acquisition of a Nigerian dairy business called Fan Milk, along with Danone. Our view on Africa is very similar to John's view. I would just add a couple points. One is that private equity, as good as the macro can be, is fundamentally about the micro. And so, wherever you're investing, whether it's China, I have good friends that are investing in Mongolia, of all places, wherever you are, you need to be able to find the businesses in the right sectors that are actually growing. And that's what we very much focus on. So, for example, on the middle class dynamics, everywhere that we see the headlines, we are also constantly looking for the nuance. So the middle class market is actually two markets. It's a mass middle market where you've got 80 million people that are escaping poverty into the lower end of the middle class. But in a place like Nigeria, you also have a significant number of people that are moving up into the upper classes. And so when we are when we're acquiring consumer-facing businesses, we're looking for businesses that are either targeting one of those markets aggressively or are developing products for both of those markets. So, water sachets for the lower end, water bottles for the upper end, cheap biscuits, branded biscuits, and I think that's a really important focus for us. The other thing I would just add is, and I'm sure John would agree with this, is Africa is growing, but that growth tends to be concentrated in certain places. We look, for example, at specific cities, and the reason we do that is whatever the macroeconomic indicators are, usually they're double that in the cities. So, for example, in a place like Kenya, Nairobi is growing about 2 times, if not 2.5 times as fast as the entire country. And as the rise of tier 2 cities, places like Kumasi, et cetera, we're looking there as well. And just to touch on this question about whether there's too much capital, I don't really think that's an issue yet. Will it become an issue? It would be a great problem to have. I think the principal challenge it'll create is around valuations, but we also think that to address that, what's going to happen is your buffer of buying well and just watching the market rise and selling at a good multiple is going to have to be tempered with investing in businesses and actually helping them grow. And I think firms like ourselves, where we have a pretty significant operational capability, that's exactly what we're anticipating. And so that's exactly what our value proposition we try to articulate to the partners that we work with. But it would be a great problem to have, I think, and I think we'd all welcome that problem.
Chijoki, what are you seeing? You're on the smaller side. What do you see in terms of competition, and what do you do differently, or how do you try to position yourself differently?
Thanks. In our space, we probably don't see much competition. So Kaizen, we are a special situations investor, so we invest in distress, turnaround. So we're very interventionist, we're very active, and some of my colleagues here, they back good management teams, good companies. At Kaizen, we back a good business model, where we would have to actually sometimes go into the company as management to resource other management as well. So I think there's only one other player in Africa that stays really deeply distressed, and that's in Egypt. It's run by Mariam Ghali. Otherwise, there's no one else, so we don't really face much competition, and it helps with valuation because we can get in at really cheap prices. But there's a lot of work to do. So I think there's probably about 4 or 5 of us in Kaizen, and I think all but one has actually been an active operator in the company.
For the larger firms, how much of an active role do you have to play in a company, and what should someone in PE going into Africa expect in terms of being on the ground, playing the role, being inside of the day-to-day operation, not just taking a seat on the board and kind of having an oversight and mentorship sort of relationship? What really is needed for these companies?
That's a great question, and there's a few ways that we actually tackle that issue. You actually find that you have to be relatively hands-on. Governance is, I think that goes without saying, and one thing that a lot of the companies want us to bring to them is a level of governance. So that's a very kind of key piece and a key pillar of what we do. But even with the larger companies that you find, and from our perspective, you find that many of the larger companies are actually better run companies. That's why you want to invest there. But even that, you do find that in places like Nigeria, you'll have a very large company because it's a large population, there's a lot of growth, so companies can become quite large and not necessarily have the best management. So we have a value creation group, which is an operating team, partners who are focused primarily on the operations of companies that we bring in at the beginning of the deal phase to help us analyze deals, decide what sort of levers we can actually push and implement, where we can actually find value. And then after we've actually invested in companies, we use them actively to help us actually extract that value in the companies. Your involvement day to day, I mean, ultimately what you really want to do is to back management teams. And we've had, through our own experiences, situations where if you don't get the management aspect correct, you're going to have a very, very difficult time of it. So attracting talent is another key issue. It's interesting because I know a lot of people have an interest in coming back to Africa, working in private equity primarily, but I think one area that people should actually consider quite actively is the operations aspect of business, general business management. There's a real lack of talent in terms of general business management on the continent, and I think ultimately that's where people are really needed.
So I would just echo those comments. You certainly want to find management that you already have a lot of confidence in. A very big part of our approach is to align them on a growth agenda. Even where we're taking a minority stake is making it very clear where we jointly see the business going and how. Third, I think they're often looking for just more than capital. I mean, they're looking for advice on governance, but they're also looking for, help with regionalization. I mean, that's a explicit part of our strategy in almost every business that we enter, and we've done that repeatedly where, we've taken South African companies across Africa, we've taken, Nigerian companies across West Africa, and they don't have those relationships, and they're looking for that. Restructuring of balance sheets, that happens on a regular basis. But we also, like Actis, have a group of professionals that are primarily coming out of a FMCG operating background. So in each of our regions, we have someone that leads that team in a group. In Africa, it happens to be the former head of Pepsi for Middle East Africa. And the reason for that is, we invest in a lot of consumer-facing businesses. And so they, most recently, we have a bakery business that, this individual went in and they were in the middle of designing a factory, and he literally redrew the factory, given his past experience, which enabled significant efficiencies and also created the ability for that business, if it wanted to add on production, to do it in a much easier way. They're looking, I think, for that kind of advice. And it's a big part of what you do, which is why I think one thing you'll notice in certainly our portfolio is The bulk of the returns are coming from profitability growth, but there is a significant portion coming from multiple expansion, which is a bit of a four-letter word in developed markets. But in these markets, it's actually a reflection of the fact that you've changed the fundamental quality of that business. It deserves a regrading. It's gone from probably a family business to an institutionalized company that is a regional, if not world-class player. And I think that reflects the operational work that private equity firms put into those businesses.
Yeah. Sure. Go ahead.
Yeah.
I'm going to add something to that. I want to know from the panel, how do you value that when you go in?
Thank you. I want to add to what Pradeep and John have been saying. So we've been talking to a lot of U.S. investors, institutional investors, and they ask us, well, is there low-hanging fruit? And our perspective is that there really isn't low-hanging fruit in Africa. You may have certain pockets in certain countries that are less developed, but our feeling is that these markets have been in private equity for many years. Sir Joy and his IFC colleagues have been investing in Africa for 20 years. So it's not like private equity just showed up in Africa. There have been a number of funds, Fund 3, Fund 4. So I agree that what we're seeing now is a much more operationally intensive model to private equity, where GPs are based on the ground. Used to be GPs would be based in London or New York. And really now you're seeing much more local intensive GPs who really are very hands-on and can make the difference.
I just wanted to add one other angle, which I totally agree with everything that's been said. But in the work that IFC does, and as an sort of an add-on to IFC, which is the asset management company of IFC, which deals with the private equity side of things, one area which has been very successful actually in IFC is working with entrepreneurs. And it's a little bit different than backing management teams or having a fairly professional outfit to help grow. And working with entrepreneurs is probably the most, of families, family-run businesses, is probably the most difficult P play of them all, because we are minority investors. We never take majority. And as a minority investor, you have to be able to have that, not just that relationship, but of course, influence. You have to have the correct rights in what you structure up front. And you also have to sometimes have the stick to actually bring to bear what you want in terms of improvements in governance, in management, in technology, in operations, every which way. And it's difficult always to price that in. I mean, I think it's a great question that you just asked, is how do you value it? And of course, you want to get in at the right time and at the right valuation so that you basically can bring some of that into play. But typically, a lot of the stuff, so for example, right now we have an investment in a company where two of my colleagues are basically sitting there for 3 weeks just trying to come up with the financing plan for all the dreams of this entrepreneur so that we can have a practical conversation with him about what works and what doesn't. And it's, I think it's a challenge. It can be done, and if it's done well, it can be extremely profitable in terms of not just building stuff the right way, because these entrepreneurs are really visionary, but also creating a lot of value doing it.
Has the work become harder? Private equity gets a bad rap, got beat up a little bit this morning, that it was overhyped and there were too many PE firms. But what you're all telling me is that it's difficult, challenging work that takes a considerable amount of time and effort. Is that obviously hard work in general is not new, but how has the work you've had to done changed, say, over the last 5 years, since you've all been in Africa for quite some time now?
I mean, so our head of Ghana, for example, has been there since 1993. And if you were to ask him kind of what's evolved, this whole theme around working with businesses to improve their operations, I think, would be a big piece of what's evolved. That was always there, but as these businesses have gotten more sophisticated, and we, for example, have seen businesses multiple times. So we've seen them in the 90s and we've seen them again in the 2000s. The quality of the expertise that you need to bring in order to grow that business has changed. So, you are oftentimes bringing in outside experts. We've hired a whole bench of people that weren't there 5 years ago. The flip side of that is there's still a talent shortfall, but there's more available now, more people that are interested in going back. Hopefully some of you are going to go back. And I think that, the professionalism and the type of talent that you need, I think, has evolved quite a bit. Along with that, I mean, there's the other kind of, if you look at our investment sizes, they've also grown, right? So the capital size of some of the transactions have grown because these markets are getting deeper. There's more strategic interest. And so, you've got a lot of, I would still say primarily European or Asian players that are, looking at these markets. They're looking for someone else, I think, in all honesty, to do the work of creating a plug and play. But I think those are a couple different ways that the market's evolved.
Yeah, I'd agree with those points. I think it's just a much more difficult game. I mean, you raised the point about strategics coming in, and I do feel like valuations have changed. And doing a deal 5 years ago or 10 years ago was completely different. What you needed to actually make a proper return is different than what you need today, which is why I think you have a lot more of these operating type teams in private equity shops. Because I think they do realize that it's not enough to have an investment manager come and sit at the board and make a couple of suggestions, and it actually helps the company. It's more competitive. The companies are a bit more complex. I think that's right. So you need that sort of level of care around the companies to help them grow. Additionally, I do think that if valuations are up and multiples are up, which they clearly are, and you think about the key levers that you have to actually generate return, you've got growth, you've got profitability, you've got leverage. These are some of the key sort of levers you have to actually push. If multiples are high and you've sort of reduced the notion of growth because you've paid for it already, then it's really through the operations that you're going to be generating your return. So I think to work around operations is actually quite important.
Well, from where I'm sitting, it's actually getting easier because, as if you look at some of the other PE funds, the first fund was like $50 million, second fund was $100 million, third fund was $200 million. So they're going, larger and larger, which means that in the SME space, there's still that gap because the way PE is structured, you want to get bigger and bigger to get bigger management fees. So you can't spend time doing a $5 million deal when you have $500 million to deploy. So, what we're seeing at the SME space is actually a gap where, I think a lot of players can still, especially in West Africa, because I think in East Africa, again, there are lots of PE funds, especially SME funds. In West Africa, I mean, they're hardly, well, speaking from the angle from West Africa, I mean, probably not to 5 indigenous PE fund managers. So, you have a lot of SMEs crying out for help. And, if you look at Actors, ACA, they're all big funds now. So you don't have many smaller PE funds looking at them. So that's where we see the opportunity.
Thank you. From our perspective, I think the one thing that we're seeing different is there's a new wave of investors coming in. So as I talked about, for the last 15, 20 years, a lot of the investment being driven in Africa has been from the development finance institutions, people like the IFC and the Africa Development Bank. But now we're increasingly seeing some commercial investors come in. So you have family offices, endowments, and foundations. So for example, our firm, we are a fiduciary to our clients. And what that means is now increasingly as commercial investors come in, there's an intense focus on governance. There's an intense focus on things like systems, ERP, but also on things like reputation risk. Right? So as we move from maybe Nigeria and Kenya into different countries, we find that there's an intense focus on making sure that you know who you're doing business with. It's a real degree of confidence, right, in terms of the AML, KYC checks, reputation checks, the background checks. It's not that these weren't done initially or that they were ignored, but I think particularly now that you have commercial capital coming in, pension funds coming in, mom and pop's pensions, grandma's pension, I think these kinds of governance issues are becoming even more important.
Going back to the point you just raised regarding SMEs, should private equity fill that gap between microfinance or venture capital and traditional private equity? How do you finance those smaller companies? Or where do they look? Or where should they look?
I think, there's definitely a role for key funds in the SME space, but I think they should also look at local high net worth investors, because that's where a lot of the funding comes from. The banks aren't doing a great job. So, and I think IFC does a good job, because that's a plug. Because they invest in, first-time fund managers, smaller teams as well. So, I mean, it's tricky. It's very difficult because you have to be local. You have to be on the ground, and on-the-ground teams are very expensive to maintain as well. So it's, it's not the most exciting work in terms of getting, great remuneration, but it's, it's needed.
Since Chijioka gave me the opening, maybe
Yeah.
I'll sort of just add on there a bit. So the way that, at least in IFC, the way we think about the SME business is basically, look, in $1 billion fund, you're trying to do $40, $50 million investment, so it's very difficult to get down to the level of the really small firms. And so the way that the IFC looks at it, for example, is just like Chijioka said, we try to approach the SMEs through intermediaries. And they may be local banks, they may be local funds, but literally IFC has been actually one of the initiators of funds, in the way that we have invested in the fund-of-fund business in first-time funds, which has been a very important part of growing the fund management business locally. And just like you said, it's a totally different business. I mean, if you're doing banking with an SME, you're basically trying to control cash on a daily basis. You know every customer that SME has. You have relationships with the family that runs the firm. It's a completely different mindset in the way you do business. And even on the on the equity side, it's also very similar. So it's given the different mindset, I'm not sure that any of the large platforms that we represent here can directly do a lot. What IFC has also been doing is we have an advisory business which basically addresses some of the issues that SMEs face on the ground. But most of the investment, I think one has to think of investing in. So if you invest in a bank, if you put capital into a bank, the bank is actually going to support a strong SME business, which could drive its growth, and that's the way you sort of think about it.
And finally, I want to touch on exits, which is an increasing focus for us and our private equity coverage at Merger Market, and in general is getting much more attention. I was at an event in New York last month, and a capital markets analyst bemoaned the fact that private equity and larger strategics are buying up all the good assets, leaving few good ones to exit through IPOs. Is there any truth to that, and how do you look at exit strategies now? Okay, you can.
So I think it is true that a lot of the smaller, medium-sized firms are being acquired either by multinationals or by PE. I think that is correct. In fact, we've invested in a couple of platforms. One is in cement, where we've invested in the African operations of a European cement company, and this company is now they have bought over cement plants in cement businesses in 7-8 markets. It's a great industry, good growth. In fact, Steve, who's sitting in the audience over here, worked on the deal when he was working with us, and that's, I think. That is what is going to happen, because some of these markets, if you look at the cement sector, which I know is a boring sector, but I love it because it's actually a very profitable sector. High prices, shortage of demand, lack of backward integration because just because of the nature of the industries in those markets. So you can have a player like that come in, putting in a lot of capital and making a big difference. So I think the market is at a phase where this is probably required a bit as well, because to attract capital, to attract what you heard from a lot of us, which is management, operational improvements, technology. You can't just do it by raising some capital in the IPO markets. You actually need much more capital. You need the talent that comes in with it. But of course, what we have seen in the past is markets going through this phase and then coming out with a whole different structure from a capital market standpoint. These companies, then there are several companies that grow and become sort of self-sufficient, and the goal in most of our cases, of a lot of these companies, we want them to be able to access the local capital markets, because that's what really puts them on a sustainable growth footing.
Yeah, I would say a couple of points. So one is, I think the growth of the private equity industry is fundamental to the growth of the public markets. At the end of the day, these companies that are being acquired are probably not ready for listing, right? So the private equity firms are going in, they're putting in systems, they're bringing in auditors, they're doing the right thing, building up these companies to a level where I think they can be listed. I think the second thing that is happening is that the public markets in Africa are quasi-private, right? They're so liquid. And so I think that some of the things that are happening now is, each of these countries, so Nigeria has an exchange, and Uganda has an exchange, and Tanzania has an exchange. And so I think one would think that over time, there'll be some pooling of liquidity in, maybe Nairobi and Lagos, and there'll be some harmonization of listing standards. So I think, together with the supply of good companies and then more of the listing standards, whether it's IFRS or other things, I think that will also help the public markets develop.
So I would echo some of Kamal's comments. I mean, so since 2000, we've done about 115 exits, and the reality is that the vast majority of those are trade sales. I mean, that's still the dominant form of exit in Africa. I don't necessarily, like the other panelists, see that as an inherent problem. I think in many of these markets, they're fragmented markets. Consolidation is a bit natural. Sometimes the private equity group is going to be the consolidator. Sometimes it's going to be selling into a strategic that is going to consolidate on its own. I think that there are potentially some challenges, though, if the IPO market picks up too quickly. And I think there are other markets around the world where you see that, where private equity turns into not what private equity is supposed to be, but basically a pre-IPO platform. I think that it is very healthy and it's not like there aren't IPOs, and we have usually multiple exit options that we're thinking through on some of our investments, and I think that's just smart. But there are other countries where you've got other markets where you basically have people that are banking on IPOs, and then when you have a situation as you do in China right now, where they've frozen IPOs for a period of time, I mean, that creates a real problem in the industry. So I think I don't necessarily see that IPOs are the end-all, be-all. I think it's fine that there's a period now where you have both options. I think the liquidity point is a great point. It's a point that comes up in our conversations because there's a lot of investors looking to access Africa right now, and they don't have necessarily the risk profile for private equity, and they're thinking about public equity, but then they realize how illiquid the markets are. So I think exits are doable. I don't see a necessary problem with IPOs, and I think the market will evolve over time. One way it's already evolved is increasingly it's South-South buyers, right? So.
Okay. You wanted to add something to that? Thanks. It's okay. Going to change tacks here a little bit. A lot of people are interested in private equity from a career standpoint. How do you get into a private equity firm? How do you choose a private equity firm or go after that as a graduating MBA student or as a washed-up journalist? I mean, it's, definitely as an MBA student. So.
And I'll come at it in a little bit with a little bit of a deviation, because there's where I work is slightly different. So what I do is private equity, but the institution is slightly different. So it's actually a development institution which has been investing in emerging markets for a long time. So our first investment in Africa was in the 60s and has developed a great track record over that period of time and has now built up a third-party business. So, so what's, so basically, where do what sort of mindset do you have to come to work for someone like us, and what are we looking for really is, clearly someone who is very strong on the commercial value-added side, but also has a development mindset. It's not just about buying and selling assets, but basically, and it's probably similar to other private equity as well, but really interested in value addition, in transforming things that they put their fingers into. Likes the international business, works with a lot of international people, and what we're looking for are really people who are thinking a little bit long term, because the key thing about, and I don't think it's just special to IFC, but I think it's the private equity business, you don't see results, you don't want to go in with a mindset of very quick results. You want to go in with a mindset of step by step to get something from A to B over a period of time with a very clear directional sense over that period of time. That's what I would say.
What skills or qualities or experience does one need to have to launch themselves into the business in sub-Saharan Africa?
I think in many ways the background of someone joining a private equity shop in Africa is the same as it would be in the States or the UK or whatever. I mean, I think a bedrock of it is going to be obviously strong finance skills. And when we do our recruiting, that's probably the first thing that we look at. So I think it's quite important to have had, a very strong foundation in finance, having worked in PE before or banking or something like that. I think that's actually critically important. And I think, that level of, intense work and grounding in those areas is really important skill to bring back to the continent. And also, I mean, many of our firms are very international, so of course your peers in different places are going to be having those same sort of skills as well. So I think there's a real demand that people need to be actually world-class in their skills. I think perhaps there was a notion at a point when people didn't have to actually be properly world-class, but I think that's exactly what we're looking for is world-class people. Secondarily, of course, I think it is a real strong interest in being in Africa, for example. So our model is that we have teams on the ground. And we think Africa is a great place to invest. We think it's difficult to invest there. We have 4 offices in Africa, and we have teams in 4 cities. We're in Cairo, we're in Nairobi, we're in Lagos, and we're in Johannesburg. So that's quite important for us. So someone has to have not only a desire to be there, but actually a sense of the market. That's really actually quite critical. So you find a lot of people who are like me, for example. I have a very American accent. I lived in the States for many, many years. Left Nigeria when I was quite young, but obviously had an interest in coming back. So over time, I visited family. I had spent some time working prior to, graduating from university, kept networks up, that sort of thing, to be really knowledgeable about the market, because that's going to be as important as your finance skills is going to be your real understanding of the markets that you're working in. Because the reality is that when you are interfacing with the local business community, they're going to say, okay, that's great, you've got an Ivy League degree, good for you. But what do you know about what we actually do here in this country? What do you know about our market?
I would really echo that. I think I'm a Wharton MBA, graduated several years ago. It took me a long time to get here. So I would say there's many paths into private equity. Many people say, I got to get in right out of business school, but I would say you can do banking consulting, but it's probably equally important to get real operational experience. So go work for a consumer products company in Africa, go work for a startup, go learn some real skill, right? And then come back to the table and you can say, I've had a great education. I can do some. I mean, everyone can do a DCF model. Let's be honest about that. That's not hard to do, right? But it's, can you really understand how companies are run? What's happening on the ground? I think that's a real skill that you can develop and then come back into private equity over time.
I think you have to be very comfortable with working with digital information as well, because yes, having a banking degree is great, but I mean, banking qualification is great, but I mean, when there's no data at all, I mean, I subscribe to capital IQ, but how do you use it? Because
Well, thank you, and thank you. We own a capital IQ as well. But.
but there isn't enough information, and you have to be. For us in Kaizen, when people talk about being active, we really are active, whereby people in Kaizen have to be very comfortable crunching numbers, but they also have to be very comfortable, making decisions where you go into a company and you have to let go 50 people, and that's what we do. So it's it's painful, but people have to be very mature. They have to be able to go to different countries, be it Rwanda, be it Kenya, be it Cote d'Ivoire, and actually interact with people from the CEO down to a cleaner and get things done. So for us, I think I would actually urge people with more of an operational background to think about careers in private equity, because I mean, there's too many financiers in African PE, and I think Africa needs people to actually just roll up their sleeves and get things done.
The only couple things I would add to that. One is, I think that the entire industry, you have to face a decision, which is, are you ready to move back, or are you going to stay here? There are people that do private equity in Africa from here. I think that's going to be a dwindling number, and so I think the ability to move back, and increasingly, I think it's going to be moved back to where your networks are. I mean, we don't even do Ghana from Nigeria, and so I think there's that. Number two, I think, in addition to the financial background, the point about emotional intelligence is really critical, because, as Kamal said, there are a lot of people who can crunch numbers, but the ability to talk to very different audiences, explain complicated things in simple ways. A lot of businesses are still family-owned. Being able to establish a rapport with that, the founder, is critical. It can often be the difference between whether that deal gets done or not. And then the third thing I would say is, I have a very strong view that a lot of people in America learned about private equity from the Romney campaign. And, that created this very specific view about what private equity is, unfortunately. And I would say for us, maybe like the IFC, it's very important that you care about the country that you're in. The people who work for us see this as a job, but they also see it as part of contributing to the rise of their country, which, that rooting in community, that rooting in you're making a difference, that rooting in you're not just manipulating numbers to get a result, but you're actually adding value, is fundamentally important to us. And it comes across, right? And so I would just say that that's not just a, I think, IFC thing. Maybe we learned that from the IFC. We've had a long relationship, but it's something that we really look for in our people.
And speaking of look for, if I am a company, I'm agnostic about the country I'm in, and I am looking for capital, and I am at the point where I believe it's advantageous to me for a private equity firm to come in and help me professionalize a little bit more and take my business to that next level, what should I look for in a private equity firm? There are many out there, but what should I be looking for? Have I stumped the panel? I doubt I've stumped the panel.
Oh yeah, I'll just say very simply, you need to be very comfortable with the private equity firm that you partner with. You're going to be eating meals with us for the next 4 to 5 years. And you're going to have some very tough conversations, and you're going to see us constantly. So I think it's a combination of, do we have the skills that, that you're looking for? Do we have the access? A number of firms have specifically talked to us about, they know that we're in the Middle East, so they want to expand in that direction. But then I think it really does come down to, do you feel a sense of alignment, both financial, values, personality with the firm that you're working with?
I think that's very well said, and the reason I think the panel was stumped for a minute is probably there's no one answer. It really depends on that chemistry, on that specific context. And I think the different firms bring different skills and approaches to the table. And it's exactly like Pradeep said. I mean, you guys we're going to work together with them for years, and we're going to have some of the most difficult discussions that they've had in their lives are going to be with these people. So it has to be a lot of it has to be chemistry, a lot of it has to be approach, mindset, all these different things.
I think the common theme here. So we make a lot of investment decisions. We look at a lot of companies. We look at a lot of partners. And at the end of the day, as much as you run your models and you run your analysis, the way we make decisions is, do we like these guys, right? It's like the way you make decisions, I like these guys. Yeah, they're good guys. I like them. And if you don't like the people that you're going to work with, it's just not going to happen.
Yeah, I would echo all those. I would also say, I agree, it's actually a difficult question, because different companies require different things, different entrepreneurs require different things. Sometimes you're dealing with family businesses, which is a completely different thing than an individual who's like a hard-charging CEO. We have situations where you have succession issues. You have situations where companies could be very, very large, but are basically run from around a kitchen table. You just have so many different situations, and so not every shop, I think, is going to be appropriate for every entrepreneur, quite honestly. Fundamentally, at its core, this is a people business. People matter, and, you can try to take the people out of the situation, but you can't. And whenever we run into trouble, it's because of the people issues. It's usually around that. One thing I think, if I'm an entrepreneur, though, I say to myself, well, have these guys done it before? Have they worked with family businesses? Have they dealt with succession issues? Have they switched strategy over time? Where have they done it? When have they done it? I think those are things that are quite core. I think from our own perspective, we just don't invest in Africa. We invest around the emerging markets. I think one of the core things that we can tell entrepreneurs is, well, we may not have experienced this yet in our market, but we've experienced it in China or India or Latin America. And we have that institutionalized knowledge that we can bring to bear in other situations, and I think that's something that actually resonates, the experience of having done it before.
Well, in some cases, people don't want to work with us, but they have no choice because there's stress. So, I mean, we're like dentists. You don't want to go, but you need us. You need to. So, but I think when they get to meet with us and interact with us, they're very relaxed, because you get intimidated when you go to panels like this and people say, we like good companies, we like this, and then you get that entrepreneur who's like, well, my company hasn't been making any money for a while, we've lost money, this happened, and then we're like, fine, great, let's talk, let's do business. And it's for some of them, they're really happy that someone's not like marking them down. We can actually see something good in their companies. So we don't mind fraud, loss, disaster, everything. We're game.
Go ahead. Please clean that up for us. Thank you.
That's a difficult one. I think I'll just switch subjects, but I just remembered a specific instance of one of the deals that we had done, which was quite interesting, because it was a company that was a manufacturer of power cables, and it was one of every private equity fund in the market was trying to get in with them, and we had gone there just to have a chat about, do you need debt? It was more of a debt discussion. And while we were having this discussion, they figured out that IFC has investments in several upstream copper projects. And for them, raw material cost is about 80% of what they do. And bang, they were like, we want to tie up with, we want an investment from IFC, because this helps us backward integrate into copper and, find ways to get supplies which are more secure, and the conversation just completely evolved into something totally different. So it's basically what we're saying. It could be for very different reasons that companies choose different firms.
Right. Okay. I think it's time that we segue into questions. I'm going to do this White House briefing room style. So one question, one quick answer, so we can get as many in. Yes, we'll start in the back there.
Just a question on the returns within Africa. Often my big focus is put on customization of client groups, but when you look globally, whether it's China with one language Mandarin, European Union is moving in a direction of integration, Latin America, Spanish or Portuguese, you've got all these regions that are simplifying, and making it easier to try and target larger markets. So do you see that as being fundamentally necessary to help generate those returns, and where do you think the pressure for that is going to come from? Is it going to be from the corporates and private equity and that kind of thing, or more from the government side trying to standardize legislation and improve that aspect of business?
I mean, there's two different questions there, I think. One is about the overall performance of private equity in Africa, which the honest answer is there's not enough funds, and we've talked to consultants about this, to really establish a true benchmark. Although Cambridge has one. The question about regionalization, that we very much think that that's part of the game. We look at Africa in regions. There are some countries in Africa that obviously offer single country scale, but we also consistently, with a majority of our businesses, take them into neighboring countries. There are an enormous number of political regional blocks in Africa, some of which are more economically relevant than others. But I think the thing to keep in mind is even in West Africa, you've got very different markets. And so, you really need three teams. You need Nigeria, Ghana, and Francophone West Africa. And so it's not an easy thing to do, but I think it's something that, we're certainly focused on it.
All right, next question. Let's see. Sure. Okay, the gentleman. We'll go to you, then the gentleman behind you.
Okay, thank you. Got a question on originations. How you seeing the originations environment? Are you seeing a lot of contested situations, or do you still get access to the proverbial sort of proprietary deal with interest? Just to get a sense of have you seen the origination landscape change over the past few years?
I think that's a really good question. You find a couple of different things going on. Clearly, we'd all say that you find a lot more contested situations. So in West Africa, Nigeria, for example, there's a lot of interest in the market. There is a lot of capital looking at deals in that market. We sort of have this joke amongst people in finance there that every Nigerian is an entrepreneur. So everyone's come back and they started their own advisory shop. And honestly, there's too many advisory shops. So every deal is intermediated if it's very large. And even smaller ones, you'll go to a small company, they make $5 million in revenue. It's just something you're maybe just interested in taking a look at. And they're like, oh, here's our advisor. And the advisors have all worked in the city or on Wall Street, and it's that sort of thing right now. So, in some respects, it makes origination easier, but it means that you're also in a very contested process. Again, I think having boots on the ground really matters. I think it really helps. There are deals out there that aren't intermediated. It requires spending time with entrepreneurs for a very long time. It has to be a 12, 18, 24-month process of sort of learning the business, wooing them, really understanding what their issues are. I think people need to view private equity as something that can help entrepreneurs solve their issues. You can bring capital, you can bring networks, you can bring your experience to help them solve some sort of issue. And I think if you approach it that way, then you can actually find deals that are proprietary. But even if they do wind up going to an auction process, you understand the business better, and so you'll be able to find those pockets of value that will allow you to actually bid for those assets and feel comfortable that you can actually get a proper return from them.
Great. The next question, gentleman behind him.
I have a question about environmental, social, and governance standards set forth by the World Bank and the IFC. So what role these standards play in your investment process? In particular, wondering whether you feel that there is a lot of good deals in Africa that you couldn't close and present to your LPs just based on that ESG standards? And related to that, how do you go about quantifying the impact of better ESG standards during your monitoring phase? Does it lead to higher exit multiple or higher EBITDA growth? Yeah.
So, I think there's three reasons why people implement ESG standards, and I say this with the IFC sitting here. One is they've got an LP that tells them to do it. Usually that's the IFC. Number two, they realize it's a risk mitigant, and number three, they realize it's a value driver. For us, we've gone through this chronologically, and we very much see it as a value driver. We have an ESG function, a dedicated ESG function at Abraj that is actually housed within our value creation team. The investment memos come with ESG due diligence, corrective actions, value accretive actions. ESG is a core component of the value creation plans that we do, the 100-day plans of our portfolio reviews. And then we also measure it annually. So we've got a proprietary index that, the Broad Sustainability Index, we like simple names, that basically evaluate our partner companies on 50+ indicators on how they're performing on ESG. Now, we think that the research is pretty unequivocal, that ESG is value accretive. And there's very simple ways, right? I mean, if you have an ISO certified business, it is simply more attractive to a strategic who doesn't want to have to worry about whether that business is going to fit into their company or not. People are very concerned about headline risk. I mean, people don't want to deal with those types of issues, so we think it's definitely a value accretive issue. I just want to mention on the sourcing, I think that it is changing. I will say that, for us, 54 investments, only 2 have not been privilegedly sourced. And so I think that, the point that John made about having even privileged understanding of businesses, even when they go to auction, is certainly true. That was definitely true of Fan Milk. And so, I think it might change, but, it's also why I don't think you need to show up today in Africa and expect to get very good unintermediated deals. If you're doing that, you're going to have to go to an advisor.
No.
Just going to add a little bit to this, with permission.
Okay.
Which is that clearly, some of you may know that what IFC has done is that we've produced a set of guidelines that's being used by a large part of the financial community. It's called the Equator Principles. But having said that, yes, I mean, when we are sourcing deals, there are several of them that we cannot do because of ESG issues or the lack of agreement with the majority shareholder on how to fix those ESG issues. And I think Kamal had referred to this earlier. Of course, what IFC brings to the table is very high standards. But now that we are working with pension funds and sovereign wealth funds as well, there is a fiduciary aspect of this as well, which complicates things even further. And yeah, we try when we see gaps to try to find a way to fix them and so that we can do the deal. But yeah, there are many cases where we walk away because we can't.
Okay, next question. Okay. Gentleman in the white shirt there.
My question is, I sat down here, I think 4 or 5 years ago, at a conference, and there was a conversation about the gap in the bonding associated with SMEs. I'm back here again 5 years later, and we're still having the same conversation about that. I mean, do you actually see this changing anytime soon? I mean, I also understand like the FC's position where you intermediaries like the banks. Like, I mean, for example, in Nigeria, if you're giving a loan to the Diamond Bank or whatever the case may be, you find out that a lot of these banks lack the expertise to or actually the desire to actually invest in this SME businesses. So, I mean, would there ever be a solution?
So the IFC has actually, in terms of what we have done with these banks, has taken some very specific steps to help them with the SME business. So one of the most popular programs that IFC's advisory group has is basically focused on SME banking with the banks. And as a part of this program, there are groups, there are basically teams at IFC who will go into that bank and train and provide training from all kinds of aspects, including credit management, credit assessment of SMEs, which is different again from the way you would, credit assess large project finance deals, and actually work with them in setting up a whole operational framework in terms of how to handle SMEs. The two banks that we have invested in, we've spent actually a great deal of time training them in the SME business, not just because it's developmental, but because we think it's very good business if it's done the right way. Because as you're saying, as you're implying, this is a growth area in Africa, and clearly, there's a lot of not just developmental aspects, but also commercial upside in tapping into that market. So we are doing what we can, but it's a big challenge, and it'll take time to sort of make it more widespread.
I think the challenge with SMEs is also one with economics. So let me be devil's advocate here. I mean, a bunch of you guys are, graduating with your MBA, you want to go back and work for PE, you want to get, let's say, $150,000 salary or even more. The challenge is that if you're investing in a company that has $2 million revenue, they can't sustain your salary. So you're going to work for the bigger PE funds who will have to invest in, a $40, $50 million deal. So the challenge to you guys is, some of you guys should go back and actually start investing in SMEs, working with the SMEs as well, because, I agree with you. I think, okay, I'm going to get in trouble here, but, IFC, who's also an investor in our fund, I also don't believe that using the banks as an intermediary is perfect. I think you really need to go direct. And until people start thinking about getting their hands dirty in operations, you're always going to have this issue where SMEs is a huge gap, because it's just not, you can't get the big salary with SME funds, you just can't. So if you guys actually start thinking, well, I want something interesting to do and not just the economics of it, then that's when SMEs will start getting some attention.
Just on the specific question about the SMEs, I don't think that will change necessarily, right? I mean, if you're looking at a company that's $1 million in revenue, $2 million in revenue, the work that you have to do to make an investment is the same, whether you're looking at a $20 million investment or a $500,000 investment. So it's the same amount of work, and there's just not enough to go around. So I do think that smallest end of the market is going to be one that's going to have to be served by the nonprofits. There's a lot of nonprofits that are more willing to make grants, kind of a thing. And also just the intermediation is going to have to get better. I just don't see it being a cost-effective way for partners like this to do that.
Sorry, can I just... I'm going to walk on eggshells here. I actually made a promise not to talk about this topic. So I think there's a couple issues, right? Because this comes up a lot. I think one issue, if I'm really honest about this, is the entrepreneurial community, the social enterprise community needs to also acknowledge that not every idea is good, and not every good idea has a business plan. And, I often, when I go speak to impact investors, leave with 30 what they think are business plans, but just aren't. And, I think there needs to be an acknowledgement that there is a shortfall of fundable ideas at a certain level as well. I think the second thing that comes up is I think there needs to be a conversation around the purpose behind funding SMEs. I've had this conversation with IFC World Bank. I think Kamal will agree with what I'm about to say, but at the sub-$1 million level, there's going to be some phenomenal SMEs, and we, by the way, have invested in that space before. We've still invested in the $1 to $10 million space, even just last year, like this year. But one of the reasons you fund in that space is really to generate an entrepreneurial ecosystem that will really kind of encourage people to go into business, and some of those businesses will go up and will be successful, and they get private equity funding, whatever else. But in this country for a long time, that entrepreneurial ecosystem funding came from the government, and it came from the government because it's really a social good as much as it is an economic good. And so I tend to agree with, Kamal and others that at least some portion of that space is going to have to be funded by people that don't expect to see a return on capital, and that's okay, But I think it's a twin set of issues, and as someone that's we've done that investing, we certainly see the potential. We've done sub-$1 million transactions and then come back a decade later and invested in those companies again. So it's definitely doable, but I think everyone needs to be transparent about what the challenges are, what the solutions are, what the motivations are, and why.
Next question, yes, right down here.
So in many developed markets, people in PE are now talking about specialization as a prerequisite rather than just a nice to have. So being specialized in a particular industry or stage in the investment process. And many people are saying that if you don't have a specialty, you're going to go out of business in the next 5-10 years. Do you think that's also true in Africa?
I think it's increasingly developing that way. Just give an example from my own business. We do look at sectors. There are areas that we focus on, and we focus on those worldwide. So we look at consumer, we look at financial services, we look at industrials, and we look at healthcare. And it's because of a sector-driven model that we think we can actually really identify the best deals, understand exactly what the drivers are in those deals, really generate returns, and use our experience from different markets to bring to bear in any given deal. The sort of notion that you can be an all-arounder, I think that is changing. I think our markets are getting more complicated. And again, I'm going to keep raising the point again and again. I mean, I think there's a lot of capital coming into the markets. So I think you really need to know exactly what it is that you're dealing with, what you're looking at, and have a real point of view on each of these businesses that you're looking at. Otherwise, you're not going to be able to generate the kind of return that you want over time. So I do think that a sector focus is the best way to look at these markets.
Next question, gentleman in the back there.
I was just curious, as obviously there's different levels of maturity even within Africa. Just as you're seeking yield, looking for it, et cetera, like what are some regions, countries that you haven't maybe looked at before that are popping up more on the radar, and what sectors? Just curious. It's kind of the frontier markets, so to speak.
He's stolen my closer, so, but that's okay. So each of you, that was my question, each of you name a country that we haven't talked about or focused on. Obviously, Nigeria, Ghana, Kenya, South Africa. You can't say any of those. So, you have many more to choose from, though.
So the IFC has 23 offices in sub-Saharan Africa. So I mean, that sort of gives you a sense of where we are beyond just those 4 or 5 countries. We just opened an office in southern Sudan. We are looking, actually, we are seeing a lot of activity in Rwanda, in Angola, DRC, lots of issues to look through, but tremendous opportunities and a lot of work to be done from a development perspective. So more and more, we are basically talking about all of these different countries. And the amazing thing is, when I look at my so our fund on the Africa side, it's just sub-Saharan Africa. We don't invest in North Africa. The growth rates across the countries, of course, we are talking about Africa, but there's, each country is different in a way, each region is different. But the growth rates across those countries is pretty amazing, and if we can find a way to work through governance issues, and other issues, there are lots of deals to be done.
Thank you. So when we look at different countries, we have a tiering system. So clearly the ones that immediately come to mind are the names you talked about. But when we look at some of the countries that we think are more opportunistic, I think the one that comes to mind more and more now is Ethiopia. Right? I think that's 90 million people. They don't have a public markets. They don't have much of a private markets, but I think over the next 10, 15 years, it's going to be 100 million people. It's going to be really the next big market just in terms of the pure capacity of the country.
I think, we're already in Rwanda, and you mentioned Ethiopia, South East Zimbabwe is a country I think has great potential. You have a highly skilled workforce. You have great businesses, great entrepreneurs, and it's just for a small issue of governance. Thanks to all. Otherwise, I think it's a phenomenal investment destination.
I think one interesting play actually is Francophone West Africa,
You have to pick one country.
using Cote d'Ivoire as a hub.
Fair enough. There you go.
They actually have really good businesses there, very well institutionalized, actually, good management teams. They had a bit of a wobble with their civil war, but I think it's actually bouncing back. We've done a couple of trips there quite recently, and I think it's a good way to play the Francophone region.
So by the time I was just hoping, what happens by the end here. So we would agree with all of those. We just made an investment in Cote d'Ivoire in the pharmaceutical sector, a brewery in Ethiopia. But I'm surprised that one that hasn't come up is Tanzania. We've historically invested there. It's a good regional play when looked at with Kenya, and we've done that. And then I don't know if North Africa is considered here or not, but we're very active in North Africa, and we think that the headline story there has really, it's an important one, but there are some very strong fundamentals across that. It's the wealthiest region in Africa. If I had to pick one, I would add to these guys
You didn't pick
Tanzania.
one either, but I'll let you decide. Thank you. Okay, great. Well, that is all the time we have for questions. I would definitely like for us to thank the panel for a very interesting and enjoyable and enlightening discussion.
Also, I'd just like to remind everybody the Career Expo is up on the 8th floor.